Let's bring our next guest analyst in, Mr. Craig Bolanos. He's a co-founder and wealth manager with VestGen Wealth Partners up in Chicago. Craig, thanks for being on.
Hey, good morning and a happy Friday. You know, Scott, I'm not used to this. 10 days in, you and I don't have data breaking at 7:30 Central in the morning. I guess we'll have to talk about something new.
All right. Well, I mean, you go first. I mean, what's top of mind with you?
Well, top of mind. Come on, it's everyone. It's the talk of the town. Is the AI bubble real? Right? I mean, I'm almost getting tired of it. Is the AI bubble real?
No.
I want to acknowledge to everybody, Scott, the parallels out there. Of course, there are parallels to the 1990s. There are in terms of rinse and repeat. Those parallels being the percentage of GDP that technology capex represents. The parallels about companies doing business and paying their customers. You're seeing those stories. But the reality is this is definitely not a valuation bubble like we saw Pets.com in the 90s. This is more of a potential CapEx bubble if the adoption of AI takes longer than anyone plans.
All right. Explain to the listeners CapEx.
So it's all about spending. Scott, you and I spend a tremendous amount of time talking about the jobs market and the softening labor market. I think what we're seeing again is companies are laying off workers at the margins in order to save revenue, save cost, that they can go and invest in artificial intelligence technology or any of the components that support that vertical. So capital expenditure is nothing more than technology spending a company is making today in the hopes of a return on investment at a future date.
Yeah, we talk about it a lot on my show, The Cow Guy Close, too. And we got a lot of smart people on there. And my takeaway is this. I like to listen to them all because everybody's got a little bit of a different take on everything. But it is and it isn't like the bubble, right, of 2000 or the dot-com bubble. It's more probably in line with 1995 when we had 5% 10-year yield. We had 3% inflation, and the stock market did just fine. Now, yeah, you can get worried about valuations. You can get worried about concentration. But we had a guest on, I don't know, 2 or 3 days ago, and actually she's on again today. But you do a history of the Dow index and go back to, say, even 1900s, early 1900s, where railroads were overvalued and a very high concentration. The market sorts it out, right? And, yeah, we could have a little bit of a pullback. And stocks, by the way, folks, they're allowed to go down. For some reason, people, that gets headlines when stocks go down, but that's the nature of the beast. That's what happens. So I'm more comfortable today than I was in 2000. Put it that way. What do you think?
I think that's very fine. I do not think that we are in an AI bubble yet. I want to just go on record making sure I say that to everybody. I don't think we're in an AI bubble yet. I don't think it's ready to pop. But I do think people need to pay attention that, Scott, you and I have talked on a number of occasions from my version of this world and valuation. The market is trading 4 to 5% above fair value, assuming we're talking $299 of earnings per share into the future, up from that $295 on the S&P. So I wouldn't call that an air pocket, but I would call it a great time in October to rebalance those equities to fixed income or equities to alternative asset classes, because I think the market's trading at a little bit of a 4 to 5% premium based on next year's earning expectations.
Yeah, and that's fine. And that happens, and the market can adjust to that, or we can grow into those expectations over time if we go sideways for a while. I mean, there's any number of things that could happen. I absolutely, totally agree with you. But I don't think – I think the Internet was a big deal. Obviously, now it's just such a part of our average everyday lives. But I'm 59 years old. I'm going to be 60 soon. I don't think I'll see something – I mean, that's so stupid to say, but – This artificial intelligence and what it's doing to businesses already, and what it's doing to productivity already, we're on the cusp of something massively transformational. And I think people just get worried about getting too over their skis about it and too excited about it. I think that they want to be cautious. And it's funny how we're all talking about an AI bubble, but nobody talks about a gold bubble. I mean, gold's the dangerous one. I mean, look at that market. But now we've got to go ahead.
Yeah, I had to jump in there. I think it's all different, Scott. I mean, everybody knows that other countries around the world, other central banks around the world, have talked for decades that maybe they shouldn't be so dollar denominated in assets, dollar denominated in their reserves. But the actions we've seen this year have finally changed that narrative, where countries are now taking appropriate action. I don't see any other countries going and selling dollars, selling treasuries, but there's plenty of evidence that they're not buying as much as they used to every single month, and we might be in a new secular trend where people don't want to allow the U.S. to have as much influence, and as those countries stay less and less dollar denominated, that money's going somewhere. How else do you explain the rise in gold consistently and constantly from March and April, along with the associated storage of value or perceived storage of value that cryptocurrency such as Bitcoin might be?
Well, I think they're both a little bit different, but I'll tell you right now, we could get to 5,000 in gold, and that's fine. You make all the money you want in it, but I tell you what, I wouldn't put a customer in it for love nor money right now if I was a broker. I would have them sign 10 waivers to make sure that I was absolved of all responsibility. Countries are made up of men. Men make mistakes. Also, these countries were heavily short bonds, too, in 2020 when we had interest rates at 1% or even 0. So they make mistakes all the time. I think this is another one. I'm not going to get involved. I think that if you look at a chart of gold, it's insane. I could never, with a hand on my heart, in good conscience, tell anybody to buy gold today. I just couldn't do it. But, people are, and again, they take comfort in the fact that these, you're right, central banks are buying it. People don't like the dollar. It's an anti-dollar trade. You can blame a little bit of, I suppose, on geopolitics and inflation if you want, but this too shall pass, is all I'm going to say. And that parabolic rise on that chart is unsustainable.
I mean, listen, does the chart look like a, Mercury rocket putting Alan B. Shepard into a low Earth orbit in like 1960 or 61? You bet that it does, but I think there's a fundamental change underpinning beneath the surface, and trends last far longer than they normally should. So, yes, I agree. I think the trend is your friend right now, but no. I mean, anybody who's going to go and over-leverage and put 10 to 20% of their assets in precious metals right now, you've already missed the move. Don't do that. Taking a little bit of Tylenol, which never cures anything, but it takes the edge off, I think that's the token allocation to gold that people can have in their portfolios, but it is a geopolitical story. I don't think it's necessarily an inflation story, and that's what makes it deeper conversations.
Well, you're right. I mean, you make some great points, but I feel, from my point of view, gold, $5,000 gold is $150 a barrel oil. Everybody said new paradigm. This is where we're going to be for a while. Bam, here's $50. We went to $40 a barrel, and you couldn't give it away. So it's 50 and 150. They smell, or 5,000 and 150 smell the same to me. 5,000 in gold and 150 in oil.
Well, hey, listen, going into a great weekend of football, we just heard the goalposts from you, right? We see it on the low, we see it on the high, and I think people should heed those stories. So, yeah, Scott, to you and all the listeners out there, may your football team do well. I'll be rolling with the Tide and back in the Chicago Bears. We'll see what happens on Saturday.
All right, brother. Awesome stuff as usual. Thanks for coming on. Craig Bolanos, he's with VestGen Wealth Partners up in Chicago. He's a co-founder and wealth partner there. We're going to go away. We're going to pay some bills. We're going to come back and talk right after this.